Welcome to Freightonomics. Zach Strickland.
Tony
Mulvey. Here to bring all that freight market intel and that macroeconomic data into your life, help you digest it, help you move forward with it. And today's show is going to be around the long game, because that's what a lot of transportation people are playing right now.
Yes.
Is the long game. They're waiting for the market to turn. But also on the other side of that equation are transportation managers and supply chain managers who have not had to really focus on too much day to day.
Yeah.
So it's kind of funny how that works. Like you get into these jobs where, you know, you basically are like, oh, I gotta go, problems, fires in the near term. And you really can't do anything about that long game. And then everything flips and you get a little bit of time.
Yeah.
But you end up not doing anything about the long game even then.
Yeah. I don't want to say stuck, but you live in the moment. They're all short-term focused, live in the moment. I'm getting my benefits right now.
Yep.
Don't have to worry about what the future really holds because we don't know when it's going to be. So it could be 2 weeks, it could be 6 months, it could be 2 years.
Yeah.
I think that's the challenge of it, right? Playing the long game is you're preparing for something and you don't know exactly when it's going to be. And if you're preparing for it to flip in a year from now and it changes in 6 months, it doesn't really matter if you were prepared for a year because all that goes out the window.
Yeah.
So I think that's the challenge of playing this longer term game or in some cases not playing it is you bring your issues into the shorter term, but you're still not ready for them when they happen. I think that's the problem.
Yeah. And I think, why people are interested in macroeconomics is because they all know that at some point you are subject to the environment with which you exist in and are participating in. And you're making a guess. The financial sector knows this all too well.
That's all it is.
Yes. You're guessing about when is your outcome going to be the most fruitful. And you have to keep the near term in highest consideration at all times because ultimately that's what you're judged by.
Yeah.
But if you don't keep a little bit back for that longer term trend, you are doing your job a disservice.
Yeah. The financial sector is the perfect example of it because, right? If you think the stock market's, the idea behind the market is to get a 6 month read or it's a 6 month gauge of where things are going to be in 6 months. And your price, ultimately it's a pricing game and you're pricing it for 6 months expectations, but you listen to people talk, they're like, oh yeah, we're long-term investors and things go up. But it's like if you're
like 9 to 12 months.
Yeah.
I think Seth
home. Yeah. You talk about the average holdings like 9 to 12 months and the return
9 to 12 months. Can you imagine? I think I'm going to invest in Walmart and then divest in 9 to 12 months based on
what happens right now, what's happening today, or in the last quarter, right? Like everything's looking backwards, predicting the future. You don't know the timing of the future, but you're making decisions of I'm already going to be out of this position.
Yeah.
It just doesn't make a ton of sense.
Well, let's focus a little bit more attention on the near term. And if you would be so kind as to count in for the market in 2 so we can at least get a grip on what's going on right now.
All right, Zach, in 3, 2, 1.
All right, first chart up, the OTVI. I kind of diverted from this last week because I thought it was relevant thanks to all that weather disruption. However, OTVI, our demand index, telling you the total number of tenders based on an index. It tells us a good idea of what that macroeconomic activity is like, especially from the consumer side. If you look at the white line there, we are above. We're still well above where we were this time last year. Well below that early 2022 period, which I don't know that we'll ever get back there necessarily. Maybe, well, at least not in the near term without some sort of catastrophe. But demand still looks relatively good from my perspective. Let's go to the next chart. Now, tender rejection rates. Really thought these would be coming down at this point. After that weather situation has kind of cleared up, most of the nation has warmed up. Not a lot of ice. Snow covers retracting. Groundhog Day is tomorrow. Probably see his shadow. Who knows? But rejection rates still above 5%. Let's go to the next chart. Spot market itself. So this is our NTIL. It's showing that spot rates also peaking above where they were this time last year. Things were a little bit more chaotic last year coming out of the holidays. This year, not so much. And we are still trending higher for dry van spot market freight. Let's go to the last chart here. Tender rejection rates broken down by van and refrigerated. Now, I'm going to spend the most time here because I think this is interesting. This is probably the most interesting one. Refrigerated rejection rates. This is a component of the OTRI itself coming down. Protect from freeze season is in full play. Rejection rates for refrigerated have been more volatile, obviously, than van sitting down there in white. However, what's driving this rejection rate stickiness is actually the van sector. The one thing with the warmer temps and everything going on, this is the one sector that should be at this point seeing some level of stabilization. However, we are not quite there yet. Could keep in mind that 5% still is historically low.
Yeah, I mean, the takeaway, you hit the nail on the head. It's all the stickiness driven by van is an interesting one because that should have, following the winter weather, if that was the catalyst, which the timing lines up that was a catalyst to tighten the market to some degree. After that kind of retracted, you would have seen carriers move back into the contract. I mean, they're still under contracts largely, but they would have moved back in, and you would have thought we would have been back closer to where we were, say, pre-December, right? Even into November in that 3.5% to 4% range. So, I mean, not a huge move down. 100 basis points are here, but it holding at this 5-ish%, just over 5%, to me shows the market is a little more fragile than initially thought.
That's it. That's exactly my takeaway, is that we're still in a relatively loose market environment. It's not like rates are blowing up and going haywire. It's just they're not dropping significantly, and now they're actually becoming a little bit more responsive off the floor, mind you. But that trend line, January, like if you look at that chart right there, rejection rates have not fallen back to where they were in early December.
No. I mean, look at I think the reefer one, just in the comparison, right? Just in the trend itself, right? That decline that we've seen over the past couple of days, you would have thought we would have seen that in the van market as well. And we haven't. And I think that is the telling sign, is that they don't typically follow perfectly in lockstep with each other, but you can see movement, especially when weather or outside influences impact the freight market. The fact that they didn't is the more telling sign of where it is. Now, we did come up end of the month, but it's January. Typically, you don't see a lot of, it doesn't really impact the market.
No.
And
you don't get a lot of, you saw the demand, it's actually fallen.
Yeah.
I mean, OTVI was dropping, but in the near term, week over week, it was still relatively elevated. But yeah, you see at the end of the month, it actually didn't have that end of the month push, and January is January, like you said. I want to talk about, I do have a little bit of background insight on why some of these rejection rates and spot rates are staying so stable. So if we pull up the RTI and FTI chart here with the NTI, so we just released the refrigerated truckload index and the flatbed truckload index to complement our national truckload index there in white to measure the other two main modes of travel in the United States on the spot market. Now, spot loads, of course, over 250 miles on average, so we don't get a lot of that short haul noise. And you can see flatbed has been slowly stabilizing. We've got refrigerated that looks like it hit a floor, just like the dry van side has. Flatbed seems to have hit a floor, but slightly later. If you look at the spot market. But van and refrigerated, those spot rates, if in the blue and the white, look like they are actually trending higher here in the new year. And so the insight that I have is we still need to give this a second because in the back end, the spot rates that are driving this higher are basically avoidances. We're seeing spot rates go higher into the colder weather environments. Pacific Northwest, tons of rain, tons of snow, maybe not, it's warming up and then it's cooling off, but it's been a constant struggle.
It's the way you get there. I think that's part of it too, right? It's not that it's affecting, like the weather's not, but it's, if you have to go across I-90 or I-80 and the weather that's coming from the Pacific Northwest across that you would be heading right into.
Well, even if there is freight there.
Yeah.
Like, which there's not typically. But even if there is freight there, I mean, it's not surprising to see rates go higher into the Pacific Northwest. But I think over the last bit, we've had a lot of weather in the northern tier, into the Midwest where the freeze, not so much snow necessarily, but the freeze really did take a hold there. And so we saw rates go higher into basically the plain states. Again, not a lot of freight there. But weather also an influence, basically saying, if you're a driver right now, turning down freight still feels
wrong,
really weird.
Like you just wouldn't think it would happen, right? I mean, you think utilization has to be darn near 100% because, like, again, if you're not moving, you're not making money, but the bills still come due, right? So like you've got to continue.
I think we're actually getting to the point where drivers are basically saying, I can't do it. Or carriers specifically too. Like, cause this is large carrier bias stuff in the tender rejection data. This is a little bit more leaning towards the smaller operators, obviously brokers, connect those to some of the larger shippers. But I think that is what we're seeing is like, they're finally hitting a point where it's like, you know what? I'm out.
And it was kind of a matter of when did that happen, right? We talked about it really last year that it seemed like summer, like you're kind of seeing the war chest that some of these smaller operators built up run out, and they're like, it's just not worth it at the prices because, again, inflation's still a thing. Even though everybody talks about inflation coming down, it's just because the inflation metric is coming down, right, doesn't mean that prices aren't going up. And I think that's the part that gets misconstrued a lot.
Agreed.
When talking about inflation numbers, just because when it's positive, prices are going up regardless. So it's slower growth in prices, not necessarily that prices are coming down.
I don't know that we're fully done. This whole like global supply chain environment is so unstable.
There's so much geopolitical risk.
But we're talking about transportation prices by the end of the year probably being on their way up. We're already seeing it. We've already heard it in the earnings reports and of course everybody's allocating a lot of it to the weather, which obviously it does have a big influence. But I think this is also telling for later in the year that this is highly likely now in 2024. Economically speaking, the Fed has signaled that cuts are definitely possible. It sounds likely this year, but not at the next meeting in March. They're saying basically like, let's hold off until May. And I think this too is helping prop up some of the potential in the market for later in the year. Yeah,
because when the Fed cuts rates, it lowers the cost of capital. And what's that do? It leads to investment.
Frees up cash.
And it frees up cash. I mean, there's so many things it helps drive. It's a demand driver. And them not leaving the likelihood of cuts later. I think anybody that was thinking it was coming in March was a little crazy. I mean, it just would have been a rapid change of a rapid pivot. I mean, this was the fourth meeting that they've kept rates stable. So the next one in March would have been the fifth meeting since they started to pause. Like, that's a very quick change in overall, like, in the inflation metrics. If you look in December, CPI went up. It's not moving. It's not necessarily headed back down to I know they have preferred other metrics that they look at opposed to that, but it's not that there's not much more room. Like, they're not going to, it definitely seems like they're not raising rates again. But inflation's still above their target, and they're not going to make a move until they see it continue towards that target. And it hasn't happened yet, and it doesn't feel like it's likely to happen given, again, some of the broader risk in the market.
Yeah, and also on that same note, the PMI came out 49.1 versus 47.1. That was not expected to grow.
No.
And so this is industrial sector centric stuff, manufacturing, new orders, et cetera. New orders expanded to 52.5 from 47.
Good.
Again, anything over 50 is expansion. Anything under, I think it's 49.2 or something is contraction. We'll call it 50. I don't know why it lands that way, but new orders expanding to me. This is like, you saw OTVI. It's not bad.
No.
So this is a demand side,
manufacturing
side thing that has been largely absent from our economy for a while.
Yeah. No, it lags, right? I mean, new orders, I mean, how long does it take for that to actually turn into something else?
Yeah.
But it's a positive sign in the right direction, right? I think it lends credence to by the back half of this year.
Yep.
Because it doesn't seem like the consumer's slowing down.
Nope. No, the consumer's already here. That never went away. We thought the consumer was going to leave.
And it hasn't.
And they haven't.
They've changed spending behavior to some degree.
And some of that's unhealthy spending. Let's not, I think I saw an article, Ryan Grody shared it with our company on doom spending, which is just another way of psychological comfort spending.
Yeah.
I feel so bad that I have to spend money to feel better.
And that's half the issue with the American consumer, right? Like, it's one of those. But to me, you see this, the PMI approaching that expansion territory is a good thing. New orders in expansion territory is a very good thing.
Yeah.
And then you start, I looked at it, it came out in the Daily Watch this morning. If you start looking at ocean data, from China to the US is like the highest level it's been since July 2022.
How about let's do that now?
That's a positive sign overall.
We've got an article. I was going to do this a little bit later, but let's go ahead and knock out the Red Sea coverage here in Newsonomics. So Greg Miller, obviously a wonderful journalist here, wrote an article saying, is the Red Sea effect on container shipping being overblown? My response to that is yes and no. Yes. So there's a few charts that I want to pull up here regarding this. Now, largely the sentiment is that it is a mix of yes and no. No, to the extent, this first chart that I'm going to pull up here, rates from Asia to Los Angeles, they're up. They're the highest they've been in over a year.
Yeah.
This is a chart of Freightos rates, spot rates for 40-foot containers. You can see the trend line here. This is not typical, especially in a market where we largely know, and part of the article points this out, there's plenty of supply. Even with the Red Sea disruptions, there's plenty of capacity moving in the world globally right now. It's just not as efficient as it once was.
Yeah.
But there's still plenty of supply. So let's look at the next chart, which is going to be rates to the East Coast, which of course I showed you the West Coast. That has the least exposure to this. Rates to the East Coast, you would think would be like, yeah, this is absolutely. Well, largely about, I would say 60 to 70% of these rates have actually had a pretty decent clip going from, this is all over the world to the East Coast, I should say, not just China or Asia. So you can see there's some flat numbers there coming from Europe for spot rates. So the Europe trade lanes coming into the United States, not nearly as impacted.
Yeah, which is interesting because you think the shipping lanes that are affected are typically with the Red Sea is Asia to Europe. You would think Europe would have some impact outbound, regardless of direction it was going.
Yeah.
But it clearly isn't. But I mean,
on the other side of the
equation, and I think some of it is they're moving capacity to service Europe, right? Pulling it off of trans-Pacific lanes.
Exactly.
And then they're using that to move from Europe to North America to some degree. And so it doesn't affect rates because the capacity is still flowing the way it was versus other ones. It's also an opportunity for
nail on the head.
Ocean carriers to just raise spot rates
There's
in a way.
That too. So let's break that down a little bit here. I've got a few more charts. So the IOTI, the Import Ocean TEUs Index, which it's a measure of demand. So it's 20-foot equivalent units in an index. Moving from China into the United States. Look at how sticky that volume is. And it's actually increasing, like you pointed out. Chinese New Year, Lunar New Year occurs in 9 days.
Yeah.
And this is not unusual to see demand spike in front of that.
No, it's the post golden week stickiness.
Yeah.
Typically, you'd see that decline.
Yeah.
You
It
saw
never really I mean, it fell back. That
does.
froth right there in October is Golden Week in October. That's their other major holiday. But you see the Chinese New Year effect last year. Deep trough.
Yeah, and then you see the peak.
Yeah.
It's not really a peak. I mean, there's no true peak in that August to September range when you would think that's the peak season on the ocean. But what you would have seen is severe weakness typically leading in following Golden Week, right? Keeps trending. It bounces back and then it trends back down lower into mid-October into November before it ramps back up to Lunar New Year. You didn't see that. It was relatively sticky, which I think is the interesting part about this, is that it shows that demand through the fourth quarter maybe wasn't as weak as anticipated, which if you're a transportation provider here, that is a positive for future demand here.
6 to 8 weeks out is what this chart is telling you from a domestic surface transportation. Let's go to the next chart here, the TU rejection index. These have been coming up over the last little bit, and it's interesting. The rejections don't work necessarily the exact same way, but this is a little bit, if you can see, this is happening before the Red Sea. We've got a couple of things going on here. The Red Sea obviously helps fuel the narrative. But then you have this situation where rejection rates have actually been trending higher over the last 6 to 8 months without that. And that's with abundant capacity.
It's to me, this is ocean carriers trying to flex their muscles and just show the power that they have.
And they can.
I mean, when there's nine that have 90, have 90% market share or something like that of containerized freight on the ocean, it's easy to do it. Ultimately, it's an artificial way to prop spot rates, and you can see it. If you go back and look at spot rate data from China to the U.S., you can see when they tried to do these, they push spot rates up, and they didn't hold. They fell back within a week. Right now, they're sticky or stickier given the conflicts. But again, it's 6 one, half dozen of the other. It
is what it is right now. I don't think we can rely on.
There's just risk.
The maritime shipping lanes are going to be at risk all year. Regardless. There's another article.
It's not just Red Sea. There's other areas.
There's all sorts of stuff going on there. So let's move on to, I think we skipped over the UPS Coyote situation here. I'm going to only hit these like high level. UPS to cut 12,000 jobs may sell the brokerage unit Coyote Logistics, which the one thing out here that they stated, basically their CEO stated, UPS didn't fully understand the heavily cyclical nature of Coyote's business, which has manifested over the past 8 years. That is irresponsible. That is. I don't know if she's saying that or to be truthful or to cover up something, but how do you purchase something of that scale without understanding how cyclical brokerage is? And you are at a transportation like company.
And it's not like they're as cyclical. I mean, UPS's domestic business is cyclical.
I don't know what to make of that statement.
Now, I will give Carol Tomei a slight pass because she wasn't CEO when they did make this acquisition.
Whoever told her that, though, I'm like,
that's who needs to be. Like, that's where the question.
Who's on your M&A team?
Because that person. I mean, it is the most cyclical business. I mean, that's the reason they sold the LTL business off, was the cyclical nature.
Which is far less cyclical
than brokerage. That's what doesn't make sense. And it was not a small acquisition. The other side of UPS, and this wasn't really even talked about, I mean, they were offering deep discounts. They're especially in the ground sector.
It's the parcel side, which there's two. Well, largely.
Amazon's in there now too as the third. I mean, I think it's larger than UPS in terms of what it handles, but offering discounts on ground and volume down 6%. It's the double whammy. And why do you have to cut 12,000 jobs? For that reason. You drop your prices and you still lost volume.
Guess what, guys? Later in the year, all that pricing power probably reverts, and it may be pretty significant.
Yeah.
Heartland, really fast. Heartland, of course, kind of a barometer for me, reported some disappointing earnings, largely due to the CFI and Smith sectors, which my big question here is, how are they still able to measure those two entities independently of the larger unit?
Yeah. And if they're the thing is, you would think, because we've seen Night Swift take on US Express and get that ship kind of turned around. Why are CFI, and this happened earlier than US Express, I mean, like 6 to 8 months before, why are they still operating at 103.8 OR? Because they've had 8
Huge
months.
declines here.
Yeah.
And so my read on this, if Heartland can't make money, it's a rough market.
Yes.
But you can't apply the same logic that you once did, that Heartland is always going to make money.
Yeah.
Because they bought these two
That
obviously really struggling sectors.
Yeah. So, I mean, overall, it
Does look like
tough.
Things are setting up though later in the year. I think we're at such a dire moment in transportation that everybody's got to watch out.
Absolutely.
Play that